All right, good morning, everyone. Welcome to Coffee with Kranz. We will be exploring with our team of experts the silver lining to lower valuations. My name is Michelle Maltzahn, and I am a business development manager at Kranz. Just a quick background on Kranz. Kranz is the recognized leader in providing financial and consulting services requested by CEOs, boards, CFOs of companies at all stages, and the most prominent venture capital and private equity firms to work with their portfolio companies. We are a leading national I cannot talk today. Bear with me, guys. We are a leading national professional services firm with access to 300 plus career consultants nationwide. We'll do a brief review of the introduction before we get started, and a little caveat here. Our panel of experts will be sharing insight, considerations, and potential impact of a lower valuation and how to think about options. With that said, we are sharing this information to give you a better understanding and with the guidance to not go it alone. Before making decisions with options, gather your experts and get their specific guidance. In other words, don't try this alone. Before we get started, as I said, a quick review of the agenda. So we'll do introductions, introduce you to our panelists today. We'll cover what's happening with valuations in the time of COVID-19, investor, founder, and management reactions, impact on employees, repricing options, and at the end, a Q&A. We are going to do our best to get as many questions answered as we can. If we're not able to answer all of the questions, we will do that in a follow-up message to you. Please submit your questions as we go through the conversation, so that way we can make sure that we're keeping track of the questions that are coming in. So, introductions. First up, we have Andrea Tiller. Andrea Tiller is the leader of our emerging growth and startup services at Kranz. She is a transformational CFO. We've got a lot of tongue twisters in these bios, guys. She is a transformational CFO with a strong 25-year track record of thinking strategically and executing operationally. She is a serial CFO in both private and public companies, including 2 IPOs and other public transactions. With multiple capital raises and multiple M&A transactions, Andrea has expertise in both the technical and operational aspects of the CFO. Next up, we have Carine Schneider. Carine is the president of AST Private Company Solutions, the provider of Astrella, a leading private company ownership tracking platform. She is an experienced and well-connected leader in private market and global compensation industry, or as I like to call her, the rock star of the equity world. Carine was formerly the president of NASDAQ Private Market Equity Solutions, CEO of Certain, founder and CEO of Global Shares, partner at PwC, and held executive positions at Morgan Stanley and Towers Watson. In 1992, Carine was the founder and executive director of the NASPP. Carine started her career as manager of shareholder relations at Oracle Corporation, where she assisted in the IPO. In 1999, Ms. Schneider founded the global equity organization that now has over 6,500 members worldwide. She served as chair for 18 years, is now chair emeritus, and was elected to the Fellow of Global Equity in 2019. Christine McCarthy is a partner in the Silicon Valley office and a member of the Technology Companies Group and the Compensation and Benefits Group. She has extensive experience advising on all aspects of equity and executive compensation plans and arrangements for multinational private and public companies, including large Fortune 500 public companies. Such advice covers the design, administration, and implementation of plans and arrangements, as well as compliance with applicable federal and state laws, including corporate securities and tax laws, NASDAQ, New York Stock Exchange rules, and accounting rules. I'm going to call you Patty. Patricia Aguilar is the technical accounting practice leader at Kranz. Patty is an experienced finance and accounting professional with over 25 years of experience. She brings a wealth of knowledge working with public and private entities, ranging from venture-backed startup enterprises to multinational public companies. Patty's expertise includes SEC reporting requirements, IPO preparation, and technical accounting, including expertise in the areas of revenue recognition, business combinations, convertible debt, stock-based compensation, and other equity arrangements and hedge accounting. Prior to joining Kranz, Patty was an audit partner at Deloitte. So with all that said and your panel of experts now introduced, let's dive in. What's happening to valuations in the time of COVID-19? Andrea, I'm going to call on you to share the real world perspective of what you're seeing with your clients.
Yeah, it's been a really interesting journey, I think, for all of us as we've gone through this crisis. With over 300 venture-backed portfolio companies as Kranz clients today, we have a fairly high volume of clients that are going through the valuation process at any given time. And this flow of valuations as we moved into March started to accelerate. And as the VCs began to take positions regarding their ongoing capital investments, it had a greater and greater effect on valuations. So we began to see some down rounds. We began to see some valuations that were actually coming in lower than the previous. And for those of us that have been in the Valley for a long time, we really wondered how folks were going to react to this, how the investors would react, how management would react, how the employees working in these venture-backed startups would react, because this was a somewhat new experience, and it was really fascinating because we didn't really get the kinds of reactions that we were expecting. Nobody was too freaked out by the down rounds. Some were indifferent, but the vast majority began to put on their thinking caps and embrace what are the potentials or the opportunities, what can I do with these lower valuations that will still assist my company going forward. And that became the genesis for today's topic, because there are lots of things you can do with a lower valuation, and there is a silver lining, particularly for your employees. Michelle, I think you're on mute.
Michelle, you're on mute.
Sorry about that, guys. Throwing this to Carine. So what are you seeing with valuations? Are you seeing them decreasing, flat, or are they going up? And what are some of the things that you see contributing to that?
Yeah, and I'd love for Christine to jump in as well and talk about what she's seeing with her clients. I was on a webinar yesterday speaking with a number of investors and asking them about what their perspectives are. And I think Andrea's dead on. I don't think too many people are panicking at this point. I think folks are seeing this either as a somewhat short-term blip. Investors are certainly very interested because obviously their money will go a bit further in terms of making investments at a lower level. I will say the one thing I found interesting that the investor said yesterday is that they are tending to make investments in companies where they already had relationships prior to COVID, and that the companies where they would have to start the whole relationship and meet and all that kind of stuff, that those are the companies that might lose. So not so much, the actual valuation is such an impact as the relationship side of it. But I don't know, Christine, what do you see?
Yeah, Carine, I think that's right. We're seeing that as well. I think investors, some investors are certainly viewing this as an opportunity to get in at companies at good valuations on good terms. And we are seeing that what you described, where investors that are already in companies are looking to reinvest, whereas companies that haven't yet received investments are having a bit of a harder time. I think in terms of actual results on valuations, we've seen some variation. We've certainly seen a lot of companies receive valuations that are down. Some are more down than others. And we've also seen some valuations that are either flat or up. And so I think it's important to keep that in mind, that it's possible that your company may actually have a valuation that's going up versus going down. And today we're here to talk about what happens if it goes down. But in terms of the valuation process, whether your valuation goes up and down, up or down, will depend largely on, you know, your business and the impact of COVID in particular on your business, which in some cases for some companies has actually been had a positive outcome on the business.
Christine, who should be thinking about getting a new 409A?
Yeah, that's a good question. There are definitely pros and cons to getting 409A valuation. So first, just from a pure technical perspective, a 409A valuation under the tax rules can be valid for up to 12 months from the date of the last valuation. The rules do require you to get a new valuation if there have been changes at the company or in the marketplace that indicate that the value may have gone up. You're not technically required under 409A to get a new valuation if you think the valuation may have gone down. So that wouldn't necessarily be a trigger. And if you do believe that the valuation's gone down, the question then is it helpful or is it good for you to get a new valuation, and what might that mean? I think Carine may have some thoughts on this, but there are a few perspectives to look at this from. One is the employee perspective. And, you know, if the belief is that the valuation's gone down significantly, there may be a desire to get that valuation and perhaps do certain things like stock option repricing. But you also have to consider how the employees will perceive that down valuation and whether, you know, it would be perceived as a real negative and, you know, contribute to low employee morale. Also, if you think the valuation may not go down significantly, and for some of our clients, we're actually having them talk to the valuation firms informally to get a sense as to whether they think the valuation will go down just a small amount or whether it would go down significantly. If you're in the position of it possibly going down just a small amount, there may be less interest in doing a repricing of your options, and in that case, there may be less interest in getting a new valuation at all.
Yeah, I would just, you know, certainly support what Christine says. When we talk to all of our valuation partners out there, they're very busy. There's a lot of stuff going on, but I would have that preliminary conversation to just see if it really makes sense. If, let's say, your last 409A was in December, you know, does it really make sense at this point? Has there been a lot of change to your business? And I can't emphasize enough, what your business does will have a big impact about whether or not the valuation is going to change. Just because we're in this time of COVID doesn't mean everyone's valuation is going down.
Yeah, and I think that also impacts your selection of a valuation firm. We see a fair diversity of firms, and there certainly are several firms that would be what I would call coin operated. You know, and so they're running on a standard methodology with very little qualitative or unusual types of inputs above and beyond the mechanics. And so since their mechanics are driving on a lot of market conditions, they are kind of consistently delivering a much more homogeneous set of valuations. If you feel strongly that your firm is not in lockstep with the market conditions, that you have unique advantages or unique challenges, and are looking for a valuation that takes some of those factors more into account, you probably will want to be selective in terms of which firm you use to provide your 409A.
One last comment that I'll make on this concept of declining valuations, being the technical accountant in the group, I just wanted to inform everyone that if your 409A does result in a lower valuation, there is going to be pressure on the company to evaluate possible impairment of some of its other assets. If you have goodwill, intangibles, those definitely need to be relooked at from an impairment perspective. And also, you know, the accounting rules provide that if there are certain events or circumstances that occur, that you need to look at whether your long-lived assets are impaired, and that would include you know, your fixed assets, for example. So just to keep that in the back of your mind as you're working through this, not to forget to kind of roll in some impairment thinking.
Very good. Thank you, Patty. I'm going to call on Andrea and Christine for this next topic. What do you see with investors, founders, and management reactions to lower valuations? And is there a difference for early stage versus late stage companies?
Yeah, so let's explore this a little bit. I've really enjoyed the comments that everybody's been making regarding the investor reactions. And the reason I'm enjoying them so much is because I think they are beginning to set out a trail of facts that is optimistic in terms of how the economy, and particularly the startup milieu, is reacting to COVID. You know, in the beginning, there was a lot of panic. Second of all, the VCs decided they were predominantly going to stand on the sidelines until they understood what the economic and financial impacts would be. But third, you know, I agree with the comments that both Carine and Christine have been saying, which is now they're looking to buy the dips. So we are beginning to see more rounds actually initiating and closing. We are beginning to see more participants, and that's a good sign, you know, for the economy and for our startup market, as it turns into a little bit more of a seller's market than a buyer's market. I think in terms of management, and I include the founders in that, we're seeing predominantly two reactions out of three possibilities. So the one that we're not seeing is, again, we're not seeing people freak out about it. There is probably a good 20% of our client firms where the founders and management are just kind of like, you know, I got other things to work on. I got a business to run. I got a product to develop. I got a market to get to. You know, this isn't in my top 5. The other two reactions that we're seeing is predominantly curiosity around, you know, we have been historically in a very job competitive market, doing hiring, particularly in some of the more in-demand technologies like artificial intelligence and machine learning, have been very, very challenging, and securing employees has been extremely competitive. And so most of our companies are looking at this as an opportunity, both to retain the talent they have been able to secure, but also to attract additional talent as they can move their focus more and more towards accelerating their business out of the main portion of the COVID crisis.
Yeah, Andrea, I'd support that as well. The conversation I had yesterday with the VC, I asked him, I said, so do you feel now that you can attract talent that you couldn't have attracted 6 months ago, and maybe even attracted them at a lower price? And he said, yeah, you know, definitely that. But the other thing is, I feel like the balance between employer and employee is starting to balance out a bit. So there is high unemployment. We have seen that on the tech sector. We have seen that in the startups. And so there's a feeling of, you know, I don't feel like I'm being held over a barrel so much anymore about, you know, I've got to give yoga lessons and free lunches and all this other stuff. Like, you know, there are a lot of people out there that are actually really good. And when you look at some of the cuts that have been made, they are actually in some of the more innovative sectors like, you know, AI and some of these other places. So I do think that there is a little bit of a reset there on the labor market. But I also think that we've seen many companies make pay cuts and, you know, across the board salary cuts. And so this is, again, an opportunity. We'll talk in a minute about how this might be able to help you. Sorry, Christy.
No problem. That's great. I was just going to talk about this a little bit from the stock option repricing perspective, which we'll get into in a little bit more detail in a few minutes. But to the extent that a company has a valuation that's gone down, and it's gone down enough where it may make sense to do a repricing of stock options. There are sometimes, different perspectives on this from investors and from the management team. So on the positive side, we sometimes see investors and management viewing this, as something that needs to be done in order to adequately incentivize and retain existing employees, particularly key employees. And oftentimes it's talked about in those terms. On the flip side, just as Andrea and Carine were just saying, the market is such that, a lot of people are thankful to have jobs to the extent that they have them. And, there is less of a need to do things like stock option repricings in order to ensure that people won't leave, because it's much harder for people to leave and find, other good jobs. Of course, key employees and really talented employees are always, at risk, even in bad times. But some investors and some management teams will view this as something that maybe doesn't need to happen. The investors will sometimes say that, the investors bought in at a particular price point, and they don't have the opportunity to reset their terms or reset their price. Therefore, why should the optionees have the opportunity to do that? I think ultimately what this comes down to is, the particular facts and circumstances that exist at the company, and where the company's business is, and how employees feel within that business, as well as company management's philosophy related to employees, and whether they fall in the camp of being very, employee favorable and protective of employees versus perhaps being, less focused on supporting the individual employees.
Yeah, and I want to add another sidebar here. Just because it's one of the more enjoyable aspects or more admirable aspects of being in tech. I was talking to a new client a couple of days ago, and he's in artificial intelligence, and we were talking specifically about GDPR and privacy issues and anti-abuse, and how you move forward and set your path above and beyond what your local legislation may be. And he mentioned that their firm as a startup had specifically hired predominantly millennials because they wanted not just the technical knowledge of the issues, but they wanted the cultural richness of a group of people who were sensitive to the societal ramifications and sought to make decisions that were highly ethical and made a contribution to society. And that extends to this particular topic as well. The vast majority of clients that we see were looking not to cut jobs. I mean, I've been in tech for 30 years. I mean, so I can tell you, in the late 90s, something like this came along and you just, terminated 25% of your workforce and went on with your life. And that's not what most of these startup management teams are doing. They're looking for ways, above and beyond the PPP, to retain employees. And whether it's, senior management taking pay cuts, or it's doing across the board pay cuts, or it's swapping cash compensation for equity, the vast majority are looking to maintain a cohesive culture within their company so they can move their company forward with their goals and objectives. And I just thought it's worth a shout out. I mean, what a blessing that this is where technology is moving to.
Yeah, I agree with you, Andrea. I think furloughs and across the board pay cuts, I don't think that was something people were talking about in 2001 or 1989 or any of these other times. I think that we are thinking of a more humane way. I know one CEO who said, look, I hope this is short term and I need to make some adjustments because that's what my board expects. But every adjustment I'm making is so temporary that I can literally put my foot on the gas and get going again. And, obviously layoffs are the hardest thing to come back from. So I think the decision where people are furloughing and doing pay cuts that could be reinstated are very positive.
Thank you.
So we did receive one question that I thought would be okay to answer now. Michelle, is this an okay time?
Sure. So we have a question. Are founders, executives using this as an opportunity to transfer their shares to related parties? And I'm going to call on you, Carine, and possibly Christine to chime in here.
Yeah, and I'll let Christine talk about the more technical side of things. I do work very closely with the liquidity providers out there in the private market, and certainly some of the liquidity programs within companies have certainly slowed down a bit right now. I think everybody's trying to figure things out, and certainly if there's a 409A valuation question, that may just suspend the idea of a program. What I've heard from the valuation providers is that when everything happened in March, all the deals just came to a screeching halt. So sellers said, I'm not sure I want to sell. Buyers said, I'm not sure I want to buy right now. And everybody just kind of walked away. In April, then what was being seen were the people who really did need to come up with cash were starting to kind of, I don't want to say do fire sales or do it at any cost, but they were very active in the market to try and see if they could either sell some of the shares or move them along. And now I've heard in May that things are back to healthy and robust and kind of normal. I don't know, Christine, if there would be a technical reason that you would recommend that someone transfer their shares if they were thinking about that, if let's say the valuation came in lower, from a tax perspective.
Yeah, I mean, I think if the valuation came in lower, I wouldn't expect people to be looking to transfer their shares because it wouldn't be the optimal time to cash out and to maximize the value that they can maybe get from those shares. And that's what we're seeing. I haven't seen it, but I suppose that if somebody felt like if they found an opportunity to transfer their shares and they weren't confident in the company and they felt like this was maybe their last opportunity to sell the shares, perhaps they would sell them at what maybe is a lower value, but we're not seeing that. I do have a couple of companies right now that are in the middle of secondary transactions, and in both of those cases, their values are up. And so, to the extent that valuations aren't going down, if they're staying flat or if they're going up, it seems to be business as usual on the secondary side of things. I do think that, well, not for one of the companies, but for the other company, there was a little bit of a pause in terms of, the buyers pausing to decide if this was the right time to still move forward, and they are moving forward. I think, that's sort of reflective of what's going on in the market more generally, that there was a pause, and now if companies are doing well and the value is flat or going up, that these types of transactions are actually happening.
Yeah, and Christine, I think the question is this the right time to transfer shares to a related party? So I don't know if that would change your answer.
Yeah, I think ultimately the question is, what value can you get for your shares? And is that, is that a value that you think is the right value and or a good time to transfer the shares? I don't think the fact that from a technical perspective, the fact that it would go to a related party versus a third party would factor in that significantly to that decision. I mean, certainly if shares are being transferred to a related party, so to a significant stockholder or a board member, then there's a question about whether the value above the 490 value would be viewed as compensatory. And if we think that, value that they'd be selling it for now would be lower, then you might be, minimizing the amount that you might have to recognize as ordinary income. But again, you're also minimizing the value you're getting in the transaction. So I'm not sure that that's a driver in the decision-making process.
How about though, if you're the related party is, you're transferring to a family trust or, trusts for your children or grandchildren or nonprofits, your church or things like that. Does that make any difference?
Yeah, I mean, this gets a little bit outside of my area of expertise, but I do think that there could be opportunities from an estate planning perspective if you're transferring the shares at a lower value. So if you transfer them into a vehicle where, at the time that the value is low and the price can appreciate inside that vehicle, whatever it is, that there absolutely might be opportunities there.
Cool.
I think it's very clear through the conversation today that this is not just a financial implication. There's a very human implication as well. And Carine, I'm going to throw this to you. What should companies be thinking about or anticipating when it comes to their employees if there is a down round?
Yeah, so I mean, this is probably something I've spent a lot of my career on, which is communicating to employees. And first of all, let me say, if you think you can keep it secret that you came in with a lower 409A or a higher 409A, it's not going to happen. I always tell people, the moment you say, can you keep this confidential or can you keep this secret, that person will go tell one person who will go tell one person. So that doesn't work. At the same time, I've worked with a lot of startups and again, many of them have younger employees who maybe aren't so sophisticated. When you hear initially our 409A came in lower, as I think, Michelle, you said, and Andrew, you said, employees could panic. Oh my gosh, is my company going out of business? Why? They don't understand all the macro and micro issues that could impact the valuation. So, my advice is always, first of all, you do need to talk to your employees about it. Many companies now have town hall meetings or, Friday beer fest or whatever they do, even if they're virtual on Zoom. I do think you need to, to some degree, have a conversation about it. I know some boards are just very sensitive about, we don't want people recording their Zoom conference calls and sending it over to TechCrunch and telling them, what's going on with the company. But I do think that, you don't have to get into the weeds, but you do need to talk about, we have an adjustment in our valuation. We're very comfortable with it. There were some external reasons why, the valuation has come in. This is not any reflection of how our company is operating or how we're performing. Just give some language around the fact that employees can take that. And, I always say it's like talking to your 8-year-old, when you come home and you say, I lost my job, that they're going to think they can't eat tomorrow. And obviously, you have savings in the bank and you're going to get a job very soon. I mean, your perspective is very different. So I do think you need to talk about it. I do think if you decide, and we're going to talk in a moment about repricing options, there is a whole communication flow around the repricing options perspective. And Christine will talk about, legally, there's things you need to do. There's decisions that employees need to make. This is not a decision made for them. They need to be active and participating. And so when you're putting a budget together in terms of how much is this going to cost, I would put some money aside to have someone who's a professional communicator come in and help you with what is the message, how do we deliver it. We can't get people together physically right now. So what will be the best way to do this in this new world? And I think companies who don't do that do run the risk of, as we said earlier, losing really good talent who don't understand and panic. And maybe they already have an offer letter. It's kind of been sitting there for a while and they may say, wow, this other company looks like they're doing much better. I'm just going to leave my company because of really a short-term situation that overall doesn't mean that the business isn't operating in a positive fashion. So I would definitely get some help there. And then I would also, we all have the open door policy, which, I would laugh about because, everybody's door is open, but I would really encourage employees to talk to their manager about it, make sure their managers are trained, that they have the FAQs, because a lot of times managers don't have a clue either. So, do a train the trainer on this. And then, you know, if you are the CEO of a company, if it's small enough, I would definitely say to, you know, the CEO, this is a time when you really need to be part of the communication and part of the message. Don't just leave it to the managers. Really be out there and talking about what's going on. And hopefully the board will support you. Like I said, you don't have to share every bit of confidential financial information at your company in order to say this is a positive thing. I do, you know, and again, I'm not a lawyer. I'm going to let Christine opine on this, but for those companies that did do a reduction in pay, you know, again, there might be legal issues why you don't want to connect the two, but this is an opportunity for you to say, we are, you know, saving cash. It's important to us. However, we are able at this time to do something for you on the equity side that will have a much longer term benefit. And so you may want to consider tying those two together. And as Michelle said at the beginning, you know, you need to get your own advice in your own situation with your own legal advisors, but no, it is something for you to consider as a message that will help the employees. Now, Christine, what do you think on this? Any legal concerns that you would have?
I'll just chime in on the last point that you were making related to tying equity to reductions in pay. So we've certainly seen companies implement programs like this. That as a general matter, there are not a lot of technical legal issues that arise if the program's being implemented on a unilateral basis, which most companies do have the ability to do. Employees are at will. Their compensation can be changed unilaterally by the company. There are exceptions to that. There are consequences sometimes if a company reduces pay unilaterally for an employee that has a provision in their employment agreement that would give them the right to quit for good reason and would trigger certain benefits if you reduce pay by more than certain amounts. So it's always important to check that. But assuming that you can reduce pay unilaterally and if you decide to at the same time grant options, there's not a lot else to be worried about to the extent that it's the two things are connected. If the program's going to be offered as an election or a choice, it does technically implicate the 498 deferred compensation rules. In this case, it's not something that creates a lot of problems for most companies. If you don't have other arrangements that are treated as deferred compensation under 409A, and you haven't implemented one of these programs before, what it means for the most part is that you need to give people the ability to make the election, but that opportunity to elect can't be outstanding for more than 30 days. And otherwise, you know, you can structure it however you like. You know, on the pay reduction side, you know, there are, of course, things to think about in addition to whether or not you can do it unilaterally. There are minimum wage and exempt, non-exempt status questions that can come up. So it's important to work those through with your advisors.
Great. Thank you, Christine. And I think this is a good time for us to really dive into the repricing options. And if you can, Christine, walk us through the mechanics of what needs to happen.
Sure, absolutely. So the first thing I'll mention is that there are a couple of different ways that these programs can be implemented. One way is to cancel options and issue new options at a new price. So that's sometimes referred to as an exchange program. And the other way this can be done is by amending the options to simply reduce the exercise price. From a substantive perspective and from a tax and legal and accounting perspective, those two transactions are really treated in the same way. So there's no benefit to following one approach over the other. And, you know, from an administrative perspective, the approach of amending options is a little bit easier. There's a little bit less paperwork. And so we tend to follow that approach and see companies following that approach to just amending the options to reduce the price versus implementing an exchange program just to simplify the administration a bit. The second thing to think about from an implementation standpoint, from a legal perspective, is if you're going to reprice stock options, and the stock options are incentive stock options, and you'll have more than a few people receiving the offer to amend their options, to reprice their options, the offer technically will be considered a tender offer under the securities rules. For private companies in this context, what that mostly means is you need to make the offer and have it remain outstanding for at least 20 business days in order to comply with the securities rules for tender offers. As a general matter, the securities rules and other rules don't require you to structure the offer in any particular way. And so you're able to include or exclude people as it makes sense from a business perspective. And sometimes companies will include other terms in the offer, so you could reprice and also change vesting or impose a blackout on exercisability. You are also free to structure those provisions and impose those provisions on different people in different ways. There are no restrictions on doing that. The only caveat is that you always need to keep in mind the general rules related to discrimination and ensure that whatever you're doing won't have a discriminatory impact from any of the traditional, perspectives. So that's, in terms of the documentation that we see and how these are implemented as a tender offer, usually there is an offer document. Different companies and different advisors do this in different ways. We tend to take a pretty simplified approach where there is a letter that describes the offer that's being made, which for the most part is, we're excited to let you know that we're repricing. And then there is a short Q&A document that's attached that walks through the mechanics of the repricing, the timing, and the deadlines by which elections need to be made. And then we typically will include some disclosure on tax treatment of options and the different tax treatment that can apply to incentive stock options and non-statutory stock options. Because sometimes these repricing transactions can cause incentive stock options to convert to non-statutory stock options. But otherwise, we don't see a lot of extensive disclosure. Sometimes, you might be familiar with disclosure that you see in a tender offer that is a secondary sale transaction where employees and other service providers are being offered the opportunity to sell shares either to the company or a third party. Those tender offer documents and disclosure documents are much more extensive than what we see in the repricing context. And that has everything to do with the fact that in those transactions, people are actually selling securities rather than just simply resetting the price that they will pay for the shares, which, in a sale of securities, it raises a lot more issues and a much greater need to include disclosure related to risks in transacting in securities and pros and cons of doing that.
Sorry, Chrissy.
I was just going to mention from a tax perspective, I mentioned a minute ago that the repricing transaction can cause ISOs to convert to non-statutory stock options. So I'll just go through this very briefly. The rules are a little bit complicated. Actually, they're quite complicated, and it's really important for companies to work with advisors to make sure that they are getting it right and doing the analysis correctly. So the first thing to know is that when you amend an option to reprice the option, an incentive stock option is treated as a deemed regrant of that incentive stock option. So it's as if you have canceled the original option and granted a new option. So we were just talking a few minutes ago about exchange transactions. If you do it as an amendment of the option where you just reduce the price from an IRS perspective and from an ISO perspective, the IRS will treat it as if you canceled it and regranted the option, regardless of how you implement it. And so when you do that, when when the option is deemed regranted, you restart your incentive stock option holding periods. So that is the period of time you need to hold incentive stock option shares before you sell them in order to get the favorable incentive stock option treatment upon sale of those shares. So that's 1 year from the date of exercise and 2 years from the date of grant. And in this case, it would be 2 years from the date of the amendment or the deemed regrant date. The second thing to understand when you have a deemed regrant is if you've included former employees in your repricing and those employees they're holding incentive stock options, so they would be within 3 months of termination of employment. So they're holding incentive stock option, but no longer employees of the company. Upon the deemed regrant, those options will automatically convert 100% to non-statutory stock options because they need to be employees on the deemed regrant date to continue to be incentive stock options. And the third rule to know about, which is the one that is quite complicated, is the $100,000 limit on incentive stock options. And in the context of a repricing or a deemed regrant, the rules are very, very complicated, and they can cause options that would originally qualify under the rules as incentive stock options to convert to non-statutory stock options in full or in part. So in short, what you're required to do is count the canceled option, the deemed canceled option, against the limit, the $100,000 limit for the year in which the option is canceled. So anything that would have counted against the limit for the year in which the options are canceled. Those shares need to count against the $100,000 limit. And then the option that's deemed regranted will count against the limit in that same year. So there's a double counting, and there's a sort of a bunching up that can happen with the calculation that can cause ISOs to convert to NSOs.
So Christine just gave us a perfect example of why we need to definitely stay connected to our experts as we work through a repricing or any kind of similar event. I just wanted to raise a couple of accounting issues, and I do understand that we have certainly on this presentation as participants, folks who are at early stage companies who may not currently, for cost benefit reasons, have chosen to account for their their stock option grants, formally, as a stock compensation expense in their financial statements. But to the extent that you, at some point in the future, will have to do that, there are some implications when you do repricing of options. The first thing is, as Christine mentioned earlier, the form of it, whether it's amended or canceled and reissued, from an accounting perspective, it's looked at the same. The details of what the changes are do matter in terms of how we account for it. All of these changes to existing stock options fall under the same rules of the modification rules under ASC 718, which is the stock compensation standard. And the basic concept is there is a need to value what additional, or basically to go through calculations to come up with the value for what you are giving the employees, the additional benefit you're giving to them by reducing, for instance, the exercise price in a repricing. And the way you go about that is you would, calculate the fair value of these options before the changed terms. So as is currently, but on the, right before you, or on the date of the modification, and then you value the options with all the changed terms, and you do a comparison of those two. Presumably, if you are reducing the exercise price, it is, you're bringing options that effectively may have been out of the money, into the money, or at the money. And so with that change, you are giving additional value, and that additional value should be recognized as compensation expense. The timing of the recognition is dependent on whether those options are vested or not. So to the extent that the options are vested, you would recognize that compensation expense immediately on the date of the modification. However, if there still are unvested options that you've changed, you've modified, those would be recognized, the expense, that additional incremental value that we calculated would be recognized over that remaining vesting term. So there's a basic concept there that you want to make sure that everyone doesn't forget that there is some accounting related to these. Most of the existing systems, the share management systems do have, you know, tools to do this calculation, but you can also do them, you know, offline in Excel as well.
Thank you,
And
Patty.
Patty, I would add one more thing too. You know, as you're going into this, you want to make sure you have enough shares. So depending upon what you're going to do, if you don't have enough shares, you know, look at your system, make sure you understand that, and you may have to have a discussion with the board.
Absolutely great to you know, increase the authorized number of shares if you don't have those.
Thank you. And it looks like we are going to go right up to the time. So if there are questions out there, please do submit them. And, you know, as I mentioned, we will absolutely get those answered to you on our follow-up. So please don't be shy about submitting questions. If there is a repricing that happens, Carine, what should you communicate to employees? When should you communicate that to them?
Yeah, and again, it's hard to say because you might have done a layoff, you might have done a salary reduction, maybe you've done nothing, you know, and so I think you have to be sensitive to what else is happening in the company. And like I said, getting a good communication consultant will really help you through that process and exactly the tone of the message. I do find it's very hard to find the right tone. Some people will be offended, some people will be excited, some people will not understand. So that's just the nature of communications. So I think it's hard to say when, but you know, as soon as possible. As Christine mentioned, this is not something you can just do overnight. I think Christine, you and I have talked about it. You know, depending upon what format you take, this could be a 2 to 3 month process. And that's if the lawyers are able to do what they need to do quickly, the board is able to do what they need to do, you can get your materials together, et cetera. So this is not something that you can just decide today and tomorrow it's all taken care of. So I do think it's a long process. And that's part of the communication process as well, is that some employees may think, okay, I'm all set, I'm all done. I mean, some employees still don't understand what vesting is. So, you know, you really have to take a moment to communicate well. It's also a great opportunity for you to remind people why you have an equity plan. So, you know, what is the purpose of the plan? How does it work? What are some of the terms? What do they mean? Because again, they probably got a grant when they became a new hire that might've been 2.5 years ago, and they don't remember any of it. So I would just, you know, encourage you again, work with somebody who knows what they're doing when it comes to talking to employees, and probably over communication is better than under communication with this. And again, if you need people to make decisions, the other thing is to think about providing somebody for the employee to talk to. I know a lot of employers will say, go get tax advice or go get financial advice. I think there's a lot of folks out there who are qualified and licensed to have these conversations with employees, who'll be willing to be available, sometimes at no cost, to help the employees through the decision. Because what you don't want is them to make a bad decision and then to blame the employer later because they made, you know, suddenly they have a big tax hit or something like that. The other thing I just wanted to mention, I know we're coming to the end here, is that if you are a company that is moving towards an IPO, and I'm not talking about potentially being acquired, but really you are considering going into the public capital markets, it is a whole new world out there, and repricing is looked at sometimes in a very different way. Valuations in public companies are, you know, daily and down to the minute. We can all go look and see what Apple's trading at or what General Electric's trading at right now. But there are institutional investors who feel very strongly about things. I would, again, talk to your legal advisors, or if you have investment banking advisors or compensation consultant advisors, talk about what this is going to mean if you are, let's say, within 12 to 18 months of an IPO. Because you may be feeling as a private company, it's just between the board and management and that's it. But this could have a longer impact as you move into the public markets, especially depending upon the breadth of your repricing and the amount of repricing. So just a caution there, another party to bring to the table to have a conversation with about this.
Yeah, and as a general matter, it's just worth noting that a repricing that occurs you know, within that time period prior to IPO will be disclosed in the S1 that's filed with the SEC. So,
yeah.
Thank you, guys. Any final thoughts from the group? You've all shared so many great thoughts and information, and a big thank you to all of our panelists today. And, you know, as I mentioned, if you have questions, please do submit those. You can also send them to admin@Kranz, KRANZ, ASSOC.com. After you percolate on this, when we leave the webinar. And we have a couple minutes if anyone has any immediate questions out there. We will be sending a follow-up message to you. We will include the recording from the webinar today and any additional questions that come in. So thank you again to all of our panelists. Thank you to all of our attendees for taking the time out to join us today. And with that, I will sign off.
Great. Thanks, Michelle.
Thank you.
Thank
Okay.
you guys.
Thank you.
Bye-bye.
Bye. Thanks, everybody.